S&P 500 closed up for the first time in 3 weeks. Nvidia closes on the number 3 position and the biggest trend everybody on the week has missed. Rate cuts for September have spiked. We're going to explain why. Global manufacturing PMI is under 50 and why you should care. 2 very specific trading patterns you can work into your own system. Smart money, dumb money confidence spread and why it changed. Nvidia triggered 3 key levels on Friday. We're going to explain what they are. Earnings this week will be critical for the market, starting with super microcomputer. Financials triggered a very specific buy signal, something we have only seen about 7 times in the past 70 years. This video is packed. Let's get to it. Hey everybody, welcome back. Well, there's a lot to go over and a lot to plan for next week, so let's get into it. First and foremost, you'll note something here, and this is the S&P, and what you're going to notice is that it can actually go up. So we had 3 straight weeks of selling, and now we have our first inside week. I think we'd be remiss in not just getting to the basics before we get into the details. We really need to take a look at smart money, dumb money, because there's a lot of really interesting things going on there. And we are getting a leading sector, and we need to address it because it looks like it's going to move pretty violently, quite frankly. But if we take a look here and we just see that inside week, it's a nice place to start, that's for sure. And let's see how we act. Now, do we get that higher high? Do we get that break? Do we have an inside week? It's really hard to believe with everything we have going on with earnings. The next Fed meeting that's coming up this week, there's just a tremendous amount going on. So I think it's gonna be really tough to just stay in an inside bar with all of this. Now, when we start getting into CME Fed tool and we start looking at the percentages and the changes that happened this week with PCE, we'll see where the percentages went, where the probability is. But let's just deal with the basics. So we're down, we have the flush, right to support, and then we form that inside bar that nobody thought we were going to get. But here we are, staring right at it. And I think that's very important to get. Now, we went through some basic indicators during the past 2 weeks, and I want to look at the MACD here on the weekly, and you can see the cross that's right here. But one of the things that we talked about in these kinds of events to get ahead of things is to go to the histogram. So I'm going to show you how I'm doing that right here and how I'm popping the histogram in. And then I'm going to get rid of the MACD and the signal. And we'll go to the 0 line and we'll just make that white and drop it really big so everyone can see it. And then we'll make it a standard line. Why they don't make it a standard line, I have no idea, but they don't. And we can see on a weekly basis, this move is not reflective. In other words, you're still dropping. Now let's go take a look at this on a daily before we go any further. And you're going to note something, and this is exactly one of the 5 main things we went through earlier in the week. If you remember, we went through this and talked about this change that happened on Monday. And you can see from that, and it's important for me to review these when I start giving details on how you can tell whether or not we're getting close to a bottom. You want to see how it played out. So on the week, we said when this changes colors, sometimes that's when you start to form a bottom. Usually you go sideways. Right? And if we just, might as well click off that 12 EMA real quick, or SMA rather. And that's pretty clear, isn't it? That marked the bottom. Now, does that mean that's the bottom before we roll again? No one has a clue. A lot depends on a lot of factors that, quite frankly, we just don't even have all the data for yet. But we are getting some really compelling data out there on some of these names that look like they can move, especially with SMCI coming out next week and what happened with Microsoft, Meta, and Google and what they're telling the street right now. And we're going to get to that. But I really want to deal with the basics. Right now, you're getting a very simple indicator that is telling you, hey, by the way, yeah, we did bottom. Now, if you look at a longer time frame, right, what we're trying to do is get through the week here. We start to focus more on the monthly stuff at the end of the quarters, but let's remove that drawing. What we're seeing is we don't have any indication here on a weekly chart that things are going to get better. Now, are we going to get that this week? Do we pop over on the Fed? I don't have a clue. So what we can say is that it's getting better on the daily, and that may extrapolate out to the weekly. That's the most that we can say, and I think that's factual. I think if you went back through time and looked at this, of course the daily is going to move before the weekly. And of course, this is a good step that we're going up, not down. It's really important when you're going through these kinds of times that you do not tell the market what it's going to do. It's very important that you allow the market to do what it's going to do, and then you take advantage of that. And there's a reason for that, especially with earnings into when you're basing. Too many people are going to get caught and chopped up in this market because they're going to tell the market what it's going to do. They're going to discuss earnings. They're going to say what's going to happen next week. And you don't know what you're going to have for lunch tomorrow. So try not to predict, try to react, and just get really, really good at learning how to manage positions, right? And learning where the best risk entries are. I'm going to go through one today that anyone can duplicate. I've gone through it before, but we're going to go through it in detail. And it's something that anyone can replicate, anybody. You just have to be aware of it. And same thing here. See how we flipped right here, and this is just a histogram, straight histogram. All I did was go to MACD, remove the lines, and put the histogram in. And the histogram is a reflection of the correlation of those two lines to one another. That's all it is. It's nothing too crazy. And when you see it change colors, you could say, okay, well, we could be bottoming here. Does it mean that you are bottoming? Well, I put the bottom in here for a couple days before we rolled. Now we can get into the depth of this as well, because there's obviously something to the depth when you're this oversold, and you are the most oversold in a period of time. I don't view that as good. I'm going to just get that out there. So I don't mind being oversold. I don't want to be the most oversold. That doesn't make me feel good. So in other words, when you were that oversold here, yes, of course you had your little bounce, right? And of course this was different structure. But where'd that lead to? Another rolling, right? Where did this one lead to? And of course we had 1.7 trillion injected in the market, but when you get that oversold, it does raise some questions. Why the velocity of the move? Because those two averages, those two lines have to spread out. So in other words, what you're really measuring here with MACD, might as well get into it. What you're measuring with MACD is the differentiation between these two lines. That's what the histogram is measuring. It's measuring the difference, and it's correlating that difference into a numeric, and then it's plotting that numeric here. That's what it's. Now you know. And probably more than you needed to know, but now you can't forget. Now you'll never forget it. But what's important about this? When we turn, we just want to know and go, hey, as long as we're going sideways here like this, as long as we're going sideways and we're changing colors, then this is what we get. Now, when you know that you're going to have an issue, when you see another long red one, something like that, you have to go, oh, I might have a problem. Hence it changes colors. Hence it all of a sudden starts changing colors again, right? And it's not a be-all end-all, but it is one thing, and I would certainly pay attention to it, especially with trading. And we also went through the McClellan oscillator this week. For time's sake, we're not going to cover that one because I really want to get into a lot of actionable data. I have a ton of data to go through. But let's look at this again on the weekly and just look at exactly what are we looking at. Well, we haven't turned here, and if we just come up here, is that really the end of the world? People are acting like you're not going to have a pullback. And I went through this in great detail talking about margin. You have to realize volatility is extremely real now. It's very real because you're having margin interest. And we went through this. But I don't want to go through that now. I want to spend more time on where we're going. And where we're going is based upon where we're going to see, and the 10-year is going to go, quite frankly. And we went through the ERP as well. But let's do it this way. Does that look like something that's showing any signs of slowing? Even just using this histogram. And I don't even use the histogram for this. That's absolutely glaring that we're going to wind up heading back to a 5-hand. And if you look at the data, like go look at the 2-year here, and we'll pop the 2-year in really quickly and drill into this. And what do you say? You're at 5% already on the 2-year. So now we're inversed, right? And so with that inversion, what we're saying is that we have about 60 basis points. Well, you're about 30 basis points now of inversion. So that's not going to make everybody warm and fuzzy. Everyone's going to keep talking about the recession because the inversion is here. And quite frankly, it doesn't really work that way, but they use it as a signal. So now we have a yield rising. How about the dollar? What's the dollar doing? Okay, well, the dollar looks like it's about ready to rip everybody's face off, doesn't it? Now, we don't have anything here with the MACD, and quite frankly, I wouldn't use it for a breakout anyway. I think it's useless to use histogram for that. But there's times and place, different tools for different things, right? You wouldn't, carpenter wouldn't be using electrician's tools, etc. So if we drop this down here, I mean, that's a flag. If this was a stock, you'd be all over it. You'd be foaming at the mouth to get in it. Now, we know a couple things. We know that a strong dollar does what? We know that a strong dollar leads to yield going higher and equity prices dropping, which creates more of the equity risk premium, which makes equities drop. That's true as long as we see equities not raise earnings. And we saw a lot of that this week. But there's really one sector that's standing out, and it's finance. And it's pretty darn impressive what's happening there in finance. I'm shocked by the bounce. Shocked, I tell you, the bounce that you got here. And I didn't expect it at all, because usually we see these bounce when yields do what yields do, right? When they go lower. That's not what's happening here. And these names are bouncing, and they look absolutely fantastic, and we're going to get into this. Take a look at this. Now, there's one thing that I like a lot, and that's data that goes back for a very long period of time, because patterns repeat themselves. And so when we can find a good pattern, something that sticks out, something that, as I like to say, is absolutely glaring, I want to pay attention to it. So in front of us is an oversold reversal with the most stocks long-term uptrend. What we're looking at is the S&P Financial, and this is XLF that you're looking at. And why is this important? Because this, again, it's not my work. This is done by Sentiment Trader, but I like their material because they put it all together for me, so I don't really have to do the due diligence. And How they're referring to it is they're referring it to as their 80-80-80 signal. And what you're getting is you're getting a gross oversold reading in regards to this. So what you have is you have percentage of stocks oversold. And what you've done is you've gone from an 80 to an 8. That's an insane move in a very short period of time. And believe me, you all know what happened to JP Morgan. We know what happened there. Then you have percentage of stocks above their 10-day. Well, you went from down here where you were at like an 8 or a 9 to about an 85, it looks like right now. And that is a substantial move in a very short period of time. What's crazier about this is not only are you above them all, look where your stochastics is. Your stochastics is still registering as if you're oversold. So you're grossly oversold, but these stocks are that high off the percentage. And then while you're still oversold and that's going on, look at the percentage of stocks over their 200-day moving average. You're still above 80, hence the 80-80-80 signal. And there was some pretty interesting data with this, some really accurate data going out 3 months. And we've been talking about what sector is going to lead when we started looking at technology. And because it doesn't look like it's going to be tech. It looks like tech's going to trade around. You're going to have some winners and losers. And we can address that very clearly. We're going to address that. I think it's really important for us to get this. So if you look at the S&P financials, oversold reversal in an uptrend and a buy signal. Financials after an oversold reversal in an uptrend buy signal. Okay, so obviously because everything else is up except for the financials, which are oversold. So they give you the data on where they would mark off these specific indicators when they happen going back to the 50s. And what I liked about it was once they aggregate it, this is what you come up with. And so again, you can go back and take a look at that slide. But if we go out a week and then all we have to do on that week is just say, okay, well, these are my dates, and then what was the mean? The median is if you take them all together, right? And then you just pick the, wherever it is, the median of those. This takes them all together, and the mean divides, right? So you always want to use the mean. But this was really interesting data, and I'll explain to you why I think it's interesting. And so anyway, numbers are a percentage of returns to signals, risk, average, MAC, reward. Z-score is plus or minus to suggest significance. So what they're showing you is this statistically significant? So that's what a Z-score is. It talks about statistical significance. So when you look at data, sometimes people will go, well, I don't know, does it mean anything? Plus or minus 2 suggests significance. So this is how you could look at statistical data, and say, if someone's like, oh, I'm up 20% on the year, really what you want to know is, what's their Sorrentino ratio or Sharpe ratio. But the Z-score is like a great way of looking at data and then determining, is there anything significant about what you're showing? And the answer is yes, here there is. All right, so let's get back to it. So here you are a week later, and then they drop it down, right? But here's what's just really cool. If I just look at the mean from the day that this triggered, what do we have here? I don't have one sector losing. And look at the positive percentages. The probability of this that's staggering. Like that's crazy numbers. It doesn't happen often, but when it does happen, it's pretty significant. So you're saying, okay, for the first week, you're up 1.7, 0.9. Okay, well, why is that? Well, 81 looks like it was, 81 was the issue. And do we have conditions like 81 now? I would say that I wouldn't say it's like 81 now. No, anything can happen. So you can't say, well, we're going to take out the bad data and we're only going to look at 97, right? We can't say that, obviously. So we have to look at these and go, no, we can't do it. So we leave all the data in. But we understand that what was going on in 81. Next, we would just drill into this and go, what about a week later? Okay, you're up. And then look at a month. And then look out 2 months. And this is where it gets really fascinating because you're talking about a huge move 2 to 3 months in. Pretty staggering move. So this is telling us pretty much what we were thinking, that we are setting up in a situation to move higher. Now, is that going to be, is this a precursor when you get that oversold? I don't know, but if you look at some of these charts, which we're about to, if you look at some of these charts, some of the big dogs, and you look at how fast they sold off and how fast they bounced, I can't remember ever seeing it move quite that fast. And what's fascinating about that is it kind of falls right into, yep, they really haven't been doing that for some time. And that's how fast we moved if you look at some of these names. Let's get to some of them. Now, before we get into the financials and some of these charts, I want you to understand what is the driving force here, what is leading us, and what led the financials a little bit here. And this little graph in front of you won't look like much, but this graph in front of you is the S&P. And what it is they do a global manufacturing index. Now this is different, right? This is very different. This is the composite. This is very different than what you see when you see the ISM manufacturing, right? So you have a S&P global composite PMI, you have a services PMI, and you have a manufacturing PMI. All right. The most important thing out of all of them, they combine the global, but the manufacturing is scaring the living bejesus out of people. Now, in front of you is actually the manufacturing. And the manufacturing was scaring everybody because it was over 50. See this 50 right here? What they don't tell you about that 50 is that means expansion. It is literally impossible for any reason to cut rates when you're over that line. If you see this trajectory, you can see from here why they were worried. And this has been leading. The S&P Global Manufacturing PMI has been leading ISM manufacturing, which came in super hot last time, and that's why we sold down. But watching this will give you a precursor to that data. And here's some other related ones to this that you can watch. Now, this is the list, okay? And what you'll see here for reference, all this is from tradingeconomics.com. All this is free. All of this is free. So when you start looking at ISM manufacturing, we came over 50. Why did that scare people? Because you're expanding. And if you go and take a look at this date, when this came out, and you can just go right on tradingeconomics.com and type it in, you will note, just go look at the move in the market. And everyone was like, what happened? Well, we're expanding. If you're expanding, then CME Fed tools, it just spiked. The chances of a rate cut were pushed out months, just over a data point that nobody was even paying attention. And you can see the reference is March. So what you're looking for is those leading indicators up to the next one of this into the Fed meeting. And then you can see here's April, right? And you can just go right through this. Now, that's why everybody is all of a sudden so interested in this data. And this is really important because we always talk about, the stool and the legs associated with it, the macro leg, the fundamental leg and the technical leg. And then we always talk about how you have to pay attention to, how that's going to sit and which leg you're going to lean on, right? All right. What happens with the macro leg is when you start leaning on it so much, you start getting into the minutia. You start getting really into the details, right? Well, what does that mean? Well, all of a sudden you're going to care about Kansas City Manufacturing Index. And you're going to be like, oh, it's at a 13 when it was previously at a 9, because that's a leading indicator to, right, the ISM manufacturing that's out March. You already have this. And so what people are doing is they're looking at Kansas City Fed, they're looking at New York Empire that's out now, right? And now all of a sudden we're all experts with this, and this is where the puck's going. So right, you always want to not go skate to where the puck is, where the puck's going. So if you start looking at this going, oh, New York Empire State Manufacturing's down, all right, so we're going to spike, all right, because it's still negative, and then oh boy, Philly Fed Manufacturing, and all these little details. That's what's driving us, but the trajectory here with the global services, the S&P, which comes out before the ISM, that's all pointing down. And I think that's really important for you to note. So you can always go back and take a look at these and see how the market acted on those dates. But let's get to it so we can get into these names. But it's important for us to understand why these names are doing what they're doing and what the changes are. So for the May meeting, you have a 97.3% chance. This is CME Fed Tool, Fed Watch. Just type it right into the Google and you can get all this for free. Everything I use, I try to find free sites so that you don't have to pay for the data. It doesn't give you all the bells and whistles of some of the other products I have, but it's free. And free's good. So this, I know it can get expensive for people. So if you take a look here, this will tell you where the current is. And then if you're going to cut rates, there's a 2.7% chance they're going to cut rates. If they cut rates, you will absolutely 100% skyrocket. There's no question about it. The market will rip if he cuts rates. If he gives any indication that he's going to cut rates, they're going to look at him like he's nuts, personally, I think. But then you get out to June, and what do you have? You have an 11.4% chance right here. Okay, so this is where status quo is. So we're nowhere near, and if you look at this, you can see the probability increased a little bit this week, but we're nowhere near where we need to be when you start flipping through these for him to even think of cutting. I mean, out to July now, right? If we look at that July level up here, right here, and what you're going to note from that is you're at a 26% chance, that 26.5 of a rate cut in July. So things have to get really, really into like the May CPI print. I guess funky would be the technical term before you get there. And then if you take a look here, this is going to get you in the target rate probabilities. And here's the current where you're at, and they'll tell you current right here. And what's cool about this is it'll take it out and go, okay, well, this is where you were a month ago to now. So you can see and go, wait a minute, you mean a month ago we had a 44% chance of 2 rate cuts, and now we have a 12% chance? Oh, well, that all ties to the equity risk premium, blah, blah, blah. And if you watch these videos, you can see all this stuff's connected. All right, so then you look a week ago and go, well, what's changed in a week? Not a lot, except that you're probably not getting 2 rate cuts by September, right? You're probably getting 1 rate cut by September at this point. And this data, in my opinion, has got to get a little weaker before that. But at least now you know what to look for, all right? So back to XLF. So the easiest plays here are to look at stuff like the FAS and see how that's going. But for me, as long as I'm above the 55, you have my attention. If we can get this to curl up, that would be great. But I would watch this here. Look at this on the weekly. I'm not really feeling this because it really didn't have the ability on the week to get up over that 50%. So if I'm not comfortable with the ETF, I'll go and take a look at another ETF like BNKU and see if that's better, because they all have different things in them, obviously, right? But that's kind of given me, not a warm and fuzzy feeling too, because you're running right into what? Resistance. So do I go and take a look at regionals? And if you go and take a look at the regionals, that's not really going to make me feel warm and fuzzy either, because everyone can see that DTL downward trend line. And I'm going to pop it in just for those that don't see it. But you can see right here, setting up, right? Here's one. And then you can obviously see another one right here. So you have two of them, and you can't even get through the mini one. So do I really want to get involved there? Is that something that's going to make me comfortable, that I'm rejecting the 200-day moving average, right? And again, I use a 12, a 22, and a 55. You should use what you're comfortable with. So, all right. So what does that mean? Well, I like financials from what I'm saying, but do I want to get involved in financials? And the answer is you probably do on a selective basis. So rule of thumb is go to the beasts. So this was one we bought in the room about a week ago, and frankly, we haven't had any concerns with it or had to do anything. We've just left it alone. It just keeps grinding higher. I believe it was on this day we got involved with it. We're doing quite well with it, and it looks excellent. But you start looking at the beasts. So you start looking at the big leaders and seeing if you could find anything, and you're starting to see names like Goldman that no one's paying attention to that's breaking out in all-time highs. And people are out there, like myself, and we're trading tech, but these names are grinding, and we should look at tech because there's a lot to look at there. But if we take a look at these names like the Goldmans, the JP Morgans, take a look at IBKR. Like we're not talking about these names and they're hitting highs. Take a look at this on the weekly chart. So we need a leader, and we're seeing that right now. I think that this is really pertinent because there's a bunch of little names in here like B. Riley. Look at the spike that you just got on it on the week. No one's talking about it. No one's saying, hey, what's going on with B. Riley? And look where you're at, okay? Friday, earnings, and here we are. And so this is really significant stuff because we need a leading sector in order for the S&P to hold its ground. We could still rotate through the other sectors, but if we don't have XLK, XLE, or XLF, which is tech, energy, or finance, we don't have a market. It's really that simple. So when I started going through it, I started to find that the brokers, for whatever reason, were holding this whole thing with we're being investigated, we're in so much trouble. Yeah, it's $8 later, and we're almost ready to take out levels. Look at this. Look at how this is setting up. This is perfect. Like when you start looking at these bases and these undercuts, like these double bottoms, like a lot of this stuff setting up to go higher. And I think that's pretty fascinating it is to me, but look at Jefferies and how Jefferies is setting up. And you can just go through the list of them over and over again. I looked at some of the M&A guys a little earlier in the year, and I was looking at Moelis, but the M&A guys like Moelis don't seem to be holding up as well. Lazard, not really as well, right? They're more the M&A guys. And they might be taking it on the chin because we're watching rates spike. And when rates spike, what happens? Well, then it's harder to finance deals, right? You can't do more M&A deals when prices are higher, the yields, the numbers don't make as much sense. You can't buy the company for a premium because the debt's too high, right? There's little nuances like that. You don't have to bore yourself with it. You just got a 30-second lesson. But when you start looking at these names where they're trading, they're taking off. So rule of thumb, and where I want you to go with this and why I'm tying all this together, the IBKRs of the world, the JP Morgans of the world, the Goldmans of the world, the Rileys of the world, why are they doing this? Margin interest. I guarantee you when you took a look at their balance sheet, they're making more on margin interest than they've made in years. And that's all because of Fed funds. And we went through this. I think we did this about a week ago. And I think it's really important for people to get this. So let's do it one more time so people can understand it, because people aren't even getting it with the volatility in the market. Everyone keeps waiting for this correction and this, and the sky is falling. And yeah, I'm not happy with where the market is, but corporate buybacks are back, and we know that as well. They're starting this week. So here we go. And now earnings weren't that bad. And we're going to get to some of that. And we have to look at how the players are changing, because we're starting to see retail come back in the market. We're going to get into that in a moment here. But take a look at this and look at how this is going right now, right? This is when your margin interest rate was zero. Most people that have been trading since 08, 09 don't even know what margin interest is, because your Fed funds was zero. Look at what it was here. And this is when everybody had a hissy fit. And then we obviously had the pandemic. And then from there, we had zero. And then we had the worst Fed in history, which we still have. And what have they been doing, right? Raising rates. That's when all of a sudden someone look at their account and go, where did $1,800 go? Margin interest. And so what this does is this creates more volatility in the market, Well, what does more volatility create? More trading. Okay, so now you're making more money per trade, right? The Citadels of the world, they make more money. Robinhoods of the world, they make more money. Okay, margin interest, they make money there. All right, it's all connected. So they're the ones that are doing the best. The brokers are doing the best because volatility's back, therefore there's more trading volume. You're going to trade more. Retail's going to trade more, I should say. It doesn't matter if institutions trade more, right? But as long as retail volume's up, they're good. And then on top of that, they're getting the margin interest. And let's take a look at what retail is actually doing right now. Now, there's been a development in smart money and dumb money with this turn and the cross right here, and we're going to talk about this. So first, for those that are newer, we don't refer to this as smart and we don't refer to this as dumb. What this is institutional. So institutional, the way that smart money and dumb money is calculated by Sediment Trader, is it's based upon institutions, and then this is ETFs and some odd lots, the way that it's calculated. And so this is retail and this is institutions. And if we refer to it like that, that gives us more information. It lets us know what one class of traders is doing. What we always note is that institutions tend to buy when we're dropping, right? Because equity risk premium, or it could be any other area in there, but you always see that where they're dropping. And I say always, and I'm paraphrasing, it's not really always, is it? Nothing's always, but process that we're following is this. We tend to drop, so when they're buying, they buy equities. Okay, and then you hit an inflection point. Usually it happens around these crosses, which is interesting. And at those crosses, you usually see some kind of convex or something along those lines. Now, I prefer when we see the dumb money get completely, utterly washed out, cross this line, and then lift. What I want and what we're going to get might be two different things. And that's what we have to focus on. What it looks like we might get is something like this, where we just have a bounce from that level. And then from there, maybe we go back up. Maybe we don't, but we're definitely getting a turn. And that turn needs to be, we need to talk about it, because when this starts to happen, and you can see from when we've dropped, for example, when we dropped from here on the dumb money until we got down to here, well, that's the exact drop that you've had. And now you're starting to turn. And these turns start marking before the moves actually start happening, if you note. But again, we want to note these crosses because these crosses are always of interest. And if you mark even like the low here, and look at what happened. Well, this was already moving beforehand. And meanwhile, institutions were doing what? They were selling into it, which is kind of crazy when you think about it. Matter of fact, if you really look at what institutions have been doing, they've really been buying the most that they've really been buying, according to smart money, all year long. So again, I'm just going to point this out so that you get this. If we were to come here and just draw a line straight across from that area and we just drop it right here, we have not seen institutions buy, or quote, smart money buy at this level all year long. And now they're buying. Meanwhile, as they're buying, what are we doing? We're hearing that, the sky is falling and everything else. So this is really important to get. Right, when you understand what the data is, we can do more with it. Now, let's take a look at a couple other things. And we're going to start with different time frames. So for example, if we take a look now, smart money, dumb money, we're just looking at the year. And here's Sediment Trader. And what are we seeing when we look at the year? Well, here's a cross. And from that cross, when we rose through as this was dropping, rose through as this was dropping, what happened? Market went higher. So we want to pay attention to this, i.e. when you cross down, what happened? Well, we went lower. And then at the same time that this started to drop, what happened? We started rotating right down here. And we can see that pretty clearly. So we're always looking for these patterns and then seeing, do they replicate themselves? And this is pretty obvious to me, that we're starting to see a little bit of a change here, and that we're starting to see institutions roll over, and we're starting to see retail get involved. Now, again, you have a long way to go before you get to a level where it's silly. We're not at that kind of level, so we could always regain and start dropping. That is possible. I mean, you've turned up here before only to roll right back down. Same exact thing could happen. The only thing I would say about something like that is, while you're doing that, what happened at that time? Institutions kept buying. So there is a little bit of a differentiation there, but I think it's worth noting. And then the other thing is looking at this in regards to just as a spread, meaning looking at smart money, dumb money combined. But I do think it's interesting that the cross happened here. And if you take a look at when that happened, and then you look at now your bottoms in, that's kind of interesting. And again, you are turning up. Now you have a little glip today where you're down a little bit going into the weekend, but I think it's important to note, and I think that this is something that we should watch. Now let's look at this in regards to just a very simple spread. Now the spread's pretty important to me because there's demarcation lines. So demarcation lines are areas where you're going to see something happen and you want to note the movement of that area. So right here is the zero. And if we take a look at the zero line, you're going to be able to determine, and again, this is smart money, dumb money, or as we refer to it, institutions, right? And now you get it. All right, good. So when you're here at that zero, what are we getting? A test, and then we rolled back over, right? So then when that's happening, it's not the best. All right, through the zero line, and then up. So what would that tell us? Through the zero line and then up. Is that going to tell us anything of consequence? So if we take a look from here over, when we're through that zero line and we just look and say, okay, is that telling us anything new that we might want to pay attention to? And so that's what we're always doing. Again, there's no guarantee of anything here, right? You want a guarantee, buy a toaster. But if you take a look here from that zero line over, once you get over for the first time, you start to get some signs of how this is playing out. You can see this here as well. It doesn't always mean that you're going to go straight up. I'm trying to use less of this data, and we all know why, because you don't have that injection of capital and they don't unwind it as much, obviously. But when you look at the last 3 attempts, or you go back all the way from 22, 23, and you look at this, that is worth paying attention to, or I think it's worth paying attention to, and I wanted to share it. Now, what I like to do with this data is I like to drill into it. So then when you take a step back, you take a look just at the year. And by looking at the year, sometimes you can get a little more clarity, sometimes not so much. But I think in this case, we're going to get a little more of it. So what we're going to do is just mark off some levels. So this is when we broke the zero line. This is when we ran above the zero line. And what we should do is leave these in. So we're going to say that we broke below the zero line, and you can see how that played out. And then you can see how we broke above the zero line and how that played out. And then you can see here again, broke and then went higher, right? And then again, broke below. So what are we noticing here, if at all? I would suggest that you're not noticing a whole heck of a lot, that it's actually really having no impact. And I want to point that out. That's really having no impact to me whatsoever, the break. What is having impact? The break through and the break back over. We could say that that has impact. So you broke through here and then you broke back over, right? But what didn't you do? Get through the zero line. So again, if we break into this on this is going to be just a 1 year. Again, this is by Sentiment Trader. It's not my line, but here's that zero line, right? And we always want to focus on certain demarcation lines and just say, hey, you know, what's really happening here? Do I need to pay attention to this? So we drop that right here, and then we're going to leave that in for a moment. Then we'll pop. We've only really done this year. And if we were to look at that and say, okay, well, what happened? Well, we tried here, and that didn't work. We tried here, and that didn't work. We got this milk toast rally. And when did we put the bottom in? Well, we put a bottom in when we were above this. Now, is there anything that's going to ring a bell that's going to do the same thing? I have no idea. Is it going to be a Fed meeting? Well, this was a Fed meeting, and I'm encompassing the whole space just so you can get a feel for it. We have a Fed meeting. So is that something that's going to come in? Because we have one of those coming up very shortly. So is that something that we have to pay attention to? Is that going to be a driver? And of course, that could be a driver. It always can be. And if we just take a look here, we're seeing the same thing over and over again. But what we want to note always, we're trying to identify patterns. And why are we trying to do this? Not for just this time, but for the next time we say it. So next time that we are under and we pop over, right, we're going to want to pay attention, right? But also we're going to want to pay attention when we get over that zero line. And what I would suggest is getting over the zero line and staying over the zero line is giving us the opportunity to put a bottom in as it has in the past. That's what I would take away from this. Now, for those that are newer, every once in a while I get asked for an update on the Alpha Chasers account. This is an account where I run pretty aggressively on the ideas that I present in the community. And I think that this is really helpful. Frankly, I think this is more helpful than when I entered that competition. I'm still in that competition. For this account's the one that's in it. I think I'm up 138% year to date in there. But the account's getting too big to actually compete in that competition. So this account started much smaller, and I think it's at like in the 4s now. So it's going to start getting a little harder there when you're competing against people that are trading smaller amounts of money, just on a percentage basis. So I have to figure out what I'm going to do there. Anyway, if you take a look here, this will show where we're up month to date. It's not reflective because there's an open position. A couple things I want to go over here. This win rate for April, in my opinion, is insanely good. If you're hitting 50% right now, in April, 56%, it's insanely good. If I go here and I go January, just so you can kind of take a look at this, and go January, and then we go to April, and this is TradeZilla. You can use whatever program that you want to do this, but I tell everybody, if you want to take this seriously, you need to journal. But if you take a look here, you can see that 53% is really where we've been. If you take a look at March, and I think that this is really important for people to get, If I take a look at March, I was at 48%. This does not happen to me. Well, I say it doesn't happen, but here it is. So it did happen. And then if I'm here, these moves, this was an after hours thing, something I built. So that's why it's skewed that way. But the purpose of this is I'm turning. So when I start to see like turning like this, I always pay attention to it. I don't want to spend too much time on this. I'm actually showing this because I want to show a trade as well. And also I was going to ask to just kind of show the P&L and what's going on in the world. So this is what's happening. Also, the average win rate, like we're fighting out there. Like you are hitting singles out there, right? This is not where it's supposed to be. This should be much closer to 2 to 1. But right now, that's not what's happening. And you're having drawdowns, right? So you can see that I'm having drawdown days that are a little different than what I've had in the past. So if you go back here and you take a look, and you go take a look at January, then you go take a look at April, and it's really important for people to get this, right? And again, this is completely skewed. It should be more, but it was like an after hours thing. We still did well with it, but we didn't do 70 in a day. We did, and we didn't lose 24. It's skewed. So, but if you take a look here, look at how well we were doing, and then look at how we're just kind of, treading water a little bit. Well, I say treading water where you're doing, 1% a day, but you get it, right? So you have to realize the environment you're in when you're trading, and that's the point of me showing this. Now, the other thing I really want to show is this trade that we did in Nvidia. And the reason that I want to show this trade is twofold. So let's get to that trade here. Have this pop up. Yep. All right, good. So if we go into it, let me find that trade. All right, so this trade followed exactly what I did in the room to the T, and I want to explain it. So what you're going to see here, and I'm going to show you it live, but what I want you to get from it is this. So you're going to see patterns, right? And I'm going to show this on a chart in a minute instead of this. But this is the pattern that I recognized. And I'm going to point it out to you in the other, in the chart in a second. But I want to show you what I did. So this is on a 5-minute chart. So I bought here, right? I think we bought a grand. All right, so we bought 1,000 shares here. And then when it went against me, I immediately closed half. Like, did not play games, get me out, boom, I'm gone, right? So if I go here, and I break it out in a minute, this is really what it looked like. So I immediately am closing half that trade when it went against me. There's no questions, there's nothing about it, because of the environment we're in. And then I'm closing some to pay for that up here into the strength. And then what I did, because this is not reflective, it's showing that I'm up 197, I'm not. But I added to it up here. I was able to add to that position up here. And that was important to me, and I'll show you why I did that up here. In this level, this 861, you'll see why that's so important in a moment. We're going to get to it, and we're going to show it live. So what we're going to do is we're going to show it live first so you can follow it, and then I'll walk through the specificity of the trade so that you can do it as well. But if you look over here, you'll get it. Like the average trade, I'm in at 849, right? And currently it shows traded 1,500, but I'm currently long 1,000 at 849 cost. I'm not doing anything with it. Right? My goal is to try to stay up and in, but we can get into that in another video as to how to do that. But let's watch it live, and then I'm going to walk through the pieces so that you're able to do it for yourself.
You're getting a bid. Now, if you flip this right here, there's 2 ways to play this. You could buy here, knowing that if you flip this, you're going back to here. So I'm going to buy a little in a bit. I'm not going to go crazy, but I figure they're going to flip it and push it and lure people in, because that's what they've been doing. And then when they do that, what I'll do is I'll sell into that. And then if that bar breaks, then I'll just get out of that bar, if I can stay in it till it forms. That's the best that I can do right now if I'm going to try and catch that. Because if I try to wait till it gets up here, I'm going to pay $2 more. Now, if we go past that open, what I bought is I'm probably just going to close some. So I just closed half of it the minute it did that. So that cost me a whopping 30 cents to do. So now I'm at a half and it cost me 30 cents. There it goes. So, all right. So I'm up $1 and change, $1.50. So I can pull something out of it now and just leave the rest on with that low as a stop. And there's nothing up 2.5, right? Pulling money out and then just leaving the rest on. And now we're at highs of the day and you can do what you want with it. But if this bar stays, that's my stop on the whole thing, plus 30 cents. But who cares, right? I'm up $5 now. This is what they're going to do. They're going to break you out and then they're going to push it. And then they're going to leave them hanging up here. So you have to be willing to ride that. If you're not, you have to pull money out on the way up. I am not. Hence, I pulled money out on the way up. That's what I'm trying to do constantly. Up 11, flipping our level. We're up 15 now. I mean, do what you want with it, obviously, but I'm going to hold it. I think we nailed that. We're up $20 now. Very difficult for me to put a swing trade on this, but I am going to hold it overnight if it stays here. But it's very difficult for me to do that until I close over the 55. and then I'm back and I'll start adding to my long-term position. I mean, that is a top, guys. So if you're doing it for the trade and if you start to break there, you might want to just close the rest. I'm going to use that as a stop. And then if this breaks, I'll be out of a third. I'll have a third of the position left.
So if you want to start seeing more patterns that I go over on trades, just very clearly, let me know. But let's get to it all. And what we're going to do is we're going to remove all indicators and everything. And we're just going to focus on the fact of what's happening here. And I think that this is going to be of much greater value. So it doesn't matter the name. We all know that this is Nvidia, but it does not matter. And what we're going to do very clearly here is we're going to mark the opening bar. So first thing that you want to do here is, why are we using a 5 versus a 1? And the reason we're doing it this way is this. You see all the up and downs, all the nonsense that you're getting in here? So whenever you start getting too much nonsense, extend your time frame. Whenever you're getting too much nonsense, extend your time. Okay, it will make things much clearer to you. And so what you do and how this pattern will help you. Wicks are price rejection. So when you have wicks and they are breaking down like this, that is telling you that you don't have sellers here. Now, when you are at the opening price, like you are right here, you have opens, rallies up, you're still within the range of that bar. Right, so nothing's been broken. Even if you trigger it up here, that would change the pattern. This bar is not even encapsulating that bar. We can't even break the low of the open. Please note that. This is really important for that pattern. See how you can't break even the open or close below the open of that bar? Okay, you have what? Wicks again. It does not matter that this wick is lower than here. It's all rejection. Matter of fact, all they did here, this actually gives you another trigger, because what they're telling you here is that we're triggering you to get the stop of the people that bought in here. And once they did that, if you go note this trade, what wound up happening was they flipped it. And as soon as they flipped it, you've gotten this long-legged doji here, right? Off that doji, people will say, oh, well, that's why you buy the doji. Yes and no. The bottom line with it was this. Once you flipped in here, this is telling you the open's holding for the first 15 minutes of the day. Then from there, you flipped here. That's when you're putting the trade on. You don't even need to use this as your stop. And this is this is the beauty of the trade and why you can lever this position here. If you broke this low, you broke the open. If you close below the open, you do not want to be in that trade. If you break the open after doing this, you don't want to be in the trade. And that's what makes this entry so important. So really what you want is, if you can get exactly how you have it, where you have 3, sometimes you're not this fortunate, but you get 2 and then it goes. But if you can have 3 like this, where you are not breaking the opening price and it is Wick City, what it's telling you is we can't even get 1 back to where we were here, but that's a video for another time. But 2, what they're saying is we can't get 1 person that wants to close below the open. We can't get 1 bar. We can't get enough selling to get 1 bar to close below the open, which tells you that whoever was buying at the open, however many people, are still buying at the open. Okay, so that is the pattern, and you want to pay attention to it. I don't know if it has a name or not. You can call it whatever you want. We can call it Wick City, but when you have 3 there and you can't break the open, and you can see how tight that got, flip there, that becomes your stop right there. This will help you greatly, in my opinion, especially off the open. Second thing about this trade that I want to go over, a lot of people were like, well, why didn't you just swing trade it off the open? Because unlike the gurus out there, I don't know what's going to happen. Okay, nobody knows anything. We don't know what's going to happen. But I know that this level is significant to me. So when I kept hitting this level, I have a long-term account that I added to it. And then when I flipped this dragonfly, I'm going to give you another one right here, another pattern that you can use. This is a dragonfly. A dragonfly pattern is when you come at the bottom, right? You form a long tail, and then that holds up here. A perfect dragonfly is the open and the close is the same on a bar. If you ever get a dragonfly at a key position on a daily chart, you want to look at it. If you ever get a dragonfly at a key position on a daily chart, even on a lower time frame, but it happens on a daily chart, you want to pay attention. So this was where I added for that trade. And the reason for that and this pattern is because I already have it marked off. These are 2 patterns that you can use and be quite successful in trading. And now what we'll do, and you have to use your money management principles, and I can do a video on that as well. But these 2 patterns that I just went over can help you greatly. Now, if you take a look at where you're at, you can see the 55s right there. I need to close over the 55 in order for this to be considered a swing trade for me. If I don't close over on the daily, I can't say I'm going to buy a swing trade and hope that all my dreams come true and it closes up like this. But what I can do is I can mark off these levels and watch how we act. So 862, and at the time it was like 861 and 3/4, that's where the 22 was. If you drop the 22 and the level of that to here, what you're going to see very clearly, let's go back to a bear chart, what you're going to see very clearly is that's exactly where we hit. Now let's get to some names. Now earnings was definitely the big theme. And we also have the other big theme was obviously the econ. But there was something that was really missed on people, and we started to see it really develop. Now, capex is capital spending. And this is why we saw semis actually go higher. They were actually up 10% on the week, with Nvidia actually moving the entire AI basket of stocks is up, electrified names. And then I just put this in here so people could actually see what's going on and see how big these companies are actually getting. And you can actually see where Nvidia is in comparison to Apple. I'm saying for some time that Nvidia will be bigger than Apple. It's just a matter of, and I so believe. So if we take a look at the capex, what's capex? Capex is how much a company is going to spend on building out. Now this was very different for these three companies, and we're going to talk about it. But the way Meta was received versus how Google was received and Microsoft was received for doing this, and I want to be really clear on the language here, all materially raised capex. Not like, oh, we're going to bump it a little bit, but, oh, we're going to bump it a lot. And that's a very important distinction that you need to be aware of. Because there's only one reason that you're going to spend more money if you're a corporation, and that's if you're making money. Now, we're not sure about Meta yet, but we're going to get into that. But I think it's a really important side note that a lot of people are looking at the market and going, I don't understand why these things are going higher. And let's dive into that. Yet, if you have to spend money to make money, yes, no, but in this arena, you need to spend money. You're not going to be able to do this without them. So let's dive into some of these names and exactly what transpired and then what we can do about it going forward. So the first one, let's just talk about Meta and the dumpster fire that was and why it was a dumpster. So you have 21 investment banks that lowered their target price on the stock. Not one, not five, 21. And what was the reason for that? And we're going to talk about this so that you get it. Here you came out and you initiated a dividend. And what that was telling the world was, we're done with the metaverse. We're done trying to turn people into giraffes and put you in this fake world. What we're going to do, we're not going to do that. We're going to go out there and just say, we're going to be like IBM. We're going to be like Apple. We're going to be like Microsoft. And we're going to issue a dividend. If you go back through time, and I've done this before for people to see, and you go and take a look at, and when you go back to, very simply, this is when Steve Jobs died. This is when Tim Cook started issuing a dividend and doing buybacks, okay? And since then, the stock has exploded. And the same thing happened with Microsoft, right? Done this a couple times for people that haven't seen this before, but it's absolutely staggering what it does to the stock. But again, right in here is where we lost Ballmer, and he went away, and that was about a decade of just sideways action. And here's when the new CEO came in, started doing buybacks, initiated a hefty dividend, and started a subscription model. Right? Very easy for pension funds and institutions that are looking very long-term, 5 to 10 years, to own a stock that has a dividend because they can figure out their assumptions. We're not going to get into all that. So what Meta does, and you can see by the move on the weekly, was they initiate the dividend, which gets everybody excited thinking, oh, you're going to be just like this. You're going to this model now. That's what institutions thought. Now, when that doesn't happen, all of a sudden you have a bunch of investors in a name that are in a name for the wrong reason. You got rid of your growth investors and you went to guys that are looking for that slow growth, but you're going to keep kicking off the dividends, and now we're going to have stability. We were looking for capex, what they were going to spend. We were looking for that number to be about 30 to 37 billion. The high end was 37 billion. And Zuckerberg was basically like, hold my beer, we're going to do 40 plus billion in spending. And by the way, revenues are going to be down because we're going to shift everything to AI. Maybe they'll change the name of the company to AI this time around, who knows? But where I'm going with this is, your free cash flow plummeted, absolutely plummeted. And that's a very important distinction for us to wrap our head around. So therefore, the people that bought on these earnings don't really want to own the stock anymore because it's not, they didn't buy what they thought they bought. So whether we get through, whether we rally or not, this will have a hard time. The important takeaway for us is, how do we profit from this? And how we're going to profit is to understand that they're going to spend way more than materially thought on CapEx geared towards AI. And we know what those names are. But if you look at Microsoft's quarter, and no, it didn't finish up, and people are like, well, we didn't finish up. Well, you came in, you were at 409, you were at 390 to 380 the next day, and then all the people here that were in, they were actually finally able to get out. So we saw some selling there. Do I like the way that it closed? Not really. Am I worried about it? Not really. What I would do is just take a look at where we're at. We closed right at the 55, 22, and 12. So you have a lot of reasons why people would sell into there, right? And so that's what we're really seeing, and we'll watch and see how this plays out. But again, their capex spending for this in this one segment went up 80% year over year. Not 80. So they're gearing up to spend a lot of money here. Google, same thing. Now what Google did, and I would strongly recommend that you listen to both of those conference calls if you have the time. And yeah, I get it, conference calls are boring, but the amount of information that you could derive from Microsoft's conference call and Google's conference call is absolutely staggering. Google's closing at a new high. What did Google do? Google took the page from the Microsoft Apple. And it's exactly what IBM did back in the day. But what are they doing? We're going to initiate a dividend. We're going to do $70 billion in buyback. And we have all this cash, and now we're going to give it to shareholders. That's what people want to hear. And the other thing that the CEO did an excellent job of, where you saw Meta really fall off, was explaining, hey, this is how people are using AI with Google. And this is how they're making money, even to give case studies on there. This is the AI products IKEA is using. This is how they're making money using these products. When people heard that and saw how it translated to dollars for them and how it helped the company, people get it, right? And so hopefully people get it. So I would listen. If you would take one thing away from this call, should be a lot you take away from it. You want to take away that. You want to listen to both of them. Specifically, if you don't want to listen to the boring stuff, just listen to the CEOs of when they spoke on Microsoft and Google, and you'll get a clear picture on, is AI a fad or not? And in my opinion, it's clearly not. But that sets us up for next week. And so what we saw on Friday, and we already walked through the trade, but what we saw was this. So you can see my 100 lines here, and we're going to clean them all off for a minute. But you can see what Nvidia is doing. And what Nvidia did in the simplest of terms was just get above that 55, which is absolutely huge for someone. Absolutely huge. So again, you already saw the trade that we did, but you're doing this going into next week. So all the fears that we had on the ASML Taiwan Semi, well, they're going away. And they were legitimate fears, but we saw some companies out of Europe that did exceptionally well, that are in that space. I'm not going to bore everybody with them, but if you look up ASM, which is a Netherlands company, they did exceptionally well. If you look at our semi-cap equipment manufacturers, KLAC was no slouch. This was absolutely no slouch on Friday, and no one's even talking about it. Everybody was so focused, right? This was not a bad quarter, and they're raising guidance. So I would look at that. Then you took a look at Lam Research. This was no slouch either. And we came out with earnings, but everybody was scared. And now look at us. Now I don't like buying stuff below the 55. I don't like doing it. I've been around a long time. I don't want to get Matumbo'd up there, so I just want to watch. And cheers to the person that realized that Matumbo actually used to wear 55. So if you take a look at Lam Research, and you take a look at these names, where does that lead us? I'm glad you asked. That leads us into this week. So this level, let me clean this off a little bit. This level is significantly important. Now, everybody got all nervous because they didn't come out and release earnings. Pardon me, they didn't pre-announce. Now, why is that important? I don't know. I don't know why that was so important that this time they weren't going to pre-announce. That doesn't mean that they're not going to beat. I think they pre-announced down here because it was such a shock. Like they were so not shocked, but there was going to be such a shock to the system that they felt the need to pre-announce earnings. Just because you're not pre-announcing doesn't mean they're not going to beat and exceed. If they miss, this will be a bloodbath. They're not going to miss. If they would have missed, they should have pre-announced. But you're still below the 55. So this means that you're going to get a lot of pressure here. Now, if you look, this is Tuesday. This is going to be huge for us on Tuesday. So you're going to want to be prepared for this and prepared Monday for what happened. It will affect Nvidia. Now, the other thing that we have to realize that will affect Nvidia and will affect semiconductors, which I showed you earlier was one of the top sectors being bought on the week. And what you need to take away from that is this. When you look at Nvidia and you say, oh, this is one of the top sectors being bought on the week. No, this is one of the top sectors bought in the past 2 trading days. Right? So if we are to look at what happened on Wednesday, Tuesday, Monday, it wasn't rosy. It wasn't fun, right? So where did we really start seeing that turn? If you take a look at the stocks here, and this is what's important for people to get. This wasn't great for the stocks. Like you weren't feeling really good about the position. And then Wednesday you were down, Thursday you reversed. The majority of this move really happened in between gaps, or you can see the huge gap here, or it happened Thursday, Friday, right into the 55. That's very important to get. Why is that important? Because people are out of position again. People are way out of position. And this is where it gets fascinating. So I am not a huge AMD fan. And if people watch these videos, they know that. Because AMD is not delivering at all. They're missing earnings. There's no real competition for Nvidia here whatsoever. We keep hearing about this, that there's going to someday be competition, but we're not seeing that yet. But there is something here that we should probably talk about. If you look at something like a Nvidia, you don't get this opportunity that often, and you do get it with AMD, so I'm just going to point it out. So here's August 1st, and here's earnings. Well, and then here's earnings here. Well, you're aligned with earnings, the previous earning, right? And that's why you went up so much, because now you had 2 quarters of earnings that did that. Now, here you are with earnings from here to here, and look at the move that you had on the earnings chart. And so where I'm going with this is here. So here's earnings, okay, and then you're like, oh, okay. So that day before the earnings, we were up 58%. That's a huge move after one earnings quarter. But this time it's a little different. So if we go here and take a look, we're actually down 8% from last earnings. So if these earnings are good, this is where I'm going with it. If these earnings are good, then everybody's going to be out of position with this company. And therefore, it could have a very large move to the upside because of that, because you're off on this earnings. Now, why they missed by a penny here or whatever they really missed by, it's not even 1%. It's not really the end of the world. But if they come out and they have a really good quarter or a solid quarter, something like this, okay, which is just a solid quarter, this is going to go higher. And that in turn is going to take semiconductors and Nvidia with it. I do think that SMCI is going to have more weight to Nvidia than something like an AMD, but that is my preference. But it doesn't really matter because you're going to find out the same day because both are coming out with earnings on Tuesday. That's it.